Today, we're very privileged to have Jeff Bush from the Washington Update here. Some of you may remember his partner, Andy Friedman, who updated us a couple years ago, brought to us by Eaton Vance. The Washington Update is the industry thought leader in guiding clients, such as yourselves, through the complex and ever-changing political and tax environment. They're respected throughout our industry. They're known for their ability to predict the outcomes of Washington's tax and fiscal deliberations, and more importantly, what their potential impact will be on you. Jeff has 26 years experience in the industry, helping clients with innovative tax solutions and insightful information. Jeff, as with the Washington Update, is nonpartisan politically. Jeff's background includes a decade in Merrill Lynch, and most importantly, he's a private pilot like I am. So we'll give that some credibility. So with that, I introduce Jeff Bush.
I really appreciate the opportunity to speak to you today. I'm normally asked to speak during lunches and dinners, so you'd think I'd be a heck of a lot skinnier, wouldn't you? But unfortunately, I make it up in between meals, I guess. But I do want to share with you, or build off something that Randy mentioned in my introduction, and that's that I'm a pilot by hobby. And so I've always been fascinated by the connections that I make between my interest in aviation and the financial industry. And I want to tell you a story of a couple of those connections. But in order for this story to make sense, you need to take this flight along with me. You need to be a passenger on US Air Flight 1549. Captain Sully Sullenberger is our pilot today. And I want you to ask yourself a question. How valuable would it be to you and I as passengers at that moment to be able to freeze time just long enough for the flight attendants to get back up and kind of walk us through that emergency landing procedure just one more time, right? Just maybe we weren't paying attention back on the ground in LaGuardia. Well, that's the first connection that I made to this story, that the value of the advice that we receive from our professional advisors like Randy and his team, it's not only the content they share with us. What also is important is the timing in which they share that information, right? Now, a few seconds go by and splash, we're in the Hudson River. There's not one of us on this aircraft that doesn't understand that it's time to stand up, find the nearest exit, and get off that plane. And that's the second connection that I made to this story, that as human beings, when we have clarity, it's much easier for us to take action. Would you agree? Okay, well, it's based on those two connections that I want to share with you what's been taking place in Washington over the recent past, how that's shaping the discussions that are going on right now, and just as importantly, where does that lead us in the near term? Where are those elements of clarity that we can pull out of the environment, or political environment, to help us take action? So in order to get started, though, I need to take a little bit of a step back, and I want to review the Fiscal Cliff Agreement. And I like to talk about the Fiscal Cliff Agreement in terms of what it does, but just as importantly, what it does not do. Well, the first thing it did was made permanent the marginal tax brackets for 99% of our country. Any families that earn less than $450,000 a year will see no marginal rate changes with these recent tax law changes. And it made those permanent. What it also did was reinstate the Peace Amendment. And the Peace Amendment only serves one purpose. For those families that earn between or over $300,000, it has the effect of lowering the value of those itemized deductions through somewhat of a complicated formula. But it's agreed upon that generally the Peace Amendment adds about 1% to your tax bill if you fall into that category. Now, what it also did was made permanent the estate tax code that existed in 2012 at that higher $5.12 million estate tax limit, but it also indexed that number for inflation. So starting in 2013, our estate tax exemption is $5.25 million. In addition to that, it maintains spousal portability. And as I go around the country, I still hear a lot of confusion about exactly what is that spousal portability mean when it relates to the estate tax code. So if you don't mind, let me explain it real quickly. If I passed away today, what the estate law says is that I can give $5.25 million to my heirs. But let's just say I only give $3.25 million, not using $2 million of my exemption. Well, my wife can then inherit that $2 million exemption. So if she passes away later this year, not only could she give away her $5.25 million, but she could also give away that additional $2 million that I did not use, for a total of $7.25 million. They just simplified that process and made it much easier. Now, it also maintained the relationship between the gift tax, generation skipping tax, and the estate tax limit. The value of the marriage of those three limits is it allows any single one of us to write a check in a maximum amount of $5.25 million to any one of our choosing while we're alive, free of any wealth transfer taxes. That's proven to be a very popular part of the existing tax law. What it also did was increase the tax rate from what was 35% taxes to a 40% estate tax rate. The final permanent tax change that was in the Fiscal Cliff Agreement was a patch to the alternative minimum tax. As you know, the alternative minimum tax is a different way of calculating what a person's individual tax liability is. And that was patched every single year starting back in the 70s. Well, for whatever reason, Congress never got around to patching it for tax year 2012. So there were 35 million households that were going to be subject to the alternative minimum tax starting in 2012, unknowingly and not having had been exposed to that tax previously. Well, that was patched and made permanent, so we don't need to worry about that anymore. Now, by my account, I've used the word permanent 3 times so far today. So I probably ought to explain what the word permanent means to the U.S. tax code, right? Now, what most people think of when they hear the word permanent, it means that it's forever. But that's not what it means in the U.S. tax code. What it means for the U.S. tax code is that there's no specific sunset date. So it does not mean that it can't change tomorrow, next week, or next year. It just means that there is no specific sunset date for that tax provision. I'll give you an example of that. The big Bush tax cuts of the year 2000, they sunset in the year 2010. So they were not permanent tax code changes. But what I've described here, these changes so far, are considered permanent changes. But again, just to remind you, that does not mean that it can't be changed next week or next month. Now, with that as a backdrop, what else was included in the Fiscal Cliff Agreement? Well, right now in 2012, now extended through 2013, anyone who's over 70 and a half, if you're charitably inclined, you can make a direct transfer from your IRA all the way up to $100,000 to a charity of your choice. So what's the difference? Why would you want to do a direct transfer rather than take the money out of your IRA and write a check to the charity? Well, that transaction, by going direct, means that it never impacts your effective tax rate. Because simply by recognizing that $100,000 and then giving it to a charity can adjust some of your tax rates. So this direct transfer is a great value-added opportunity that's been extended for tax year 2013. Now, the Democrats got a win inside the Fiscal Cliff Agreement. The win the Democrats got was an extension of these enhanced unemployment benefits. And again, those are only through year 2013. The win the Republicans got was an extension of, or a delay of, the sequestration spending cuts. The cuts that were supposed to go into effect on January 1 were kicked back to March 1. So let me explain quickly why that was a win for the Republicans. The reason it was a win is it allowed the Republicans to marry 2 issues together: the sequestration spending cuts with the appropriations bill. The appropriations bill is what actually funds the line items in the federal budget. So by marrying those 2 issues together, the Republicans were were able to force President Obama and the Senate Democrats to maintain those lower levels of spending. However, at the same time, giving both the Department of Defense and the agency heads on the domestic side flexibility in how they actually apply those cuts. Because the real issue with the sequestration spending cuts were not necessarily that the cuts were being made, it was how the cuts were being made. The way the law was written, every single line item of the federal budget on that discretionary portion of the budget would be cut off at the bottom. It didn't matter whether it was an important project or a silly project, it got the same cut. So by marrying those two issues together, the federal government is actually decreasing their spending by $1.2 trillion over the next 10 years, but doing it in a little bit smarter way. So let's talk about what the fiscal cliff agreement did not do. The first thing it did not do was delay the implementation of the 3.8% healthcare reform tax. This is the new tax on taxable investment income for those individuals earning more than $250,000, and that's what is helping pay for the healthcare reform law. Over the next 10 years, that 3.8% tax on taxable investment income will generate about $700 billion of additional tax revenue. So that went into effect starting January 1. What also happened on January 1 is our employee portion of our payroll taxes went back to the statutory 6.2%. As you know, we had been paying an artificially low 4.2% for the last several years. But sadly, and most concerning to me, is that there wasn't anything in the fiscal cliff agreement that actually decreased federal spending by even a single dollar, nor did it increase the percentage of American families who are paying federal income taxes. As you know, and Governor Romney made famous, only about 55% of our population actually pay federal income taxes. Not that the other 45 don't pay taxes. They absolutely do. They pay a lot of taxes. They just simply don't pay income taxes. But nothing inside the fiscal cliff agreement actually increased that percentage of Americans contributing at the income tax level. Most concerning is it did nothing to increase the certainty from our political environment. So this air of uncertainty and confusion and polarized Washington still is perpetuated regardless of this fiscal cliff agreement. And I think you would agree, as I've described the fiscal cliff agreement, it really was a tax deal first and foremost. So what I thought I'd do is put it in a table form for you. We tend to be visual creatures, so it may be easier to see in a table. So you can very quickly see that President Obama was able to fulfill his promise and that he would not raise taxes on any families that are less than $250,000. Regardless of what kind of income is received, it's still at that lower Bush tax cut level. The lion's share of these tax increases fall on these families that earn $450,000 or more. Be it the marginal taxes, the ordinary taxes, or investment return. The families in between are impacted as well. If your family earns between $250,000 and $300,000 a year, you see the impact of that 3.8% healthcare reform tax right there. The families between the $300,000 and $450,000 not only have that 3.8% tax, but they have that 1% from the Peace Amendment that I talked about earlier. So you can see that this is very much a tax deal. Now, one thing I want to make very clear when we look at this table, though, a lot of people are very concerned about this increased marginal tax rate that the quote-unquote wealthy are paying. The reality is, even the wealthy individuals on the first $450,000 of their income are still paying those lower Bush tax cuts rates. It's only the $450,000th dollar and above that actually has a marginal tax increase. So I think it's important. We tend to think of only the top marginal rate rather than the actual brackets that we move through. So with that as a backdrop, let's talk about where we're going now. We believe at the Washington Update that Congress and Washington only acts when they're absolutely forced to do so. And we call those forcing events. So let's talk about what's forcing action at this point. Well, the current deadline we're working with is the debt limit deal. Well, hold on a second. I thought we dealt with that. We did. We delayed it 5 months. So in Washington, I guess that's meaningful. And the Republicans realized when they're talking about the debt ceiling earlier this year, they realized they had a tremendous amount of leverage over President Obama. But they had to be willing to let the U.S. default on their credit. And what they quickly realized is even the majority of Republicans weren't willing to go along with that as a threat. So it became somewhat of a paper tiger issue for the Republicans. But that doesn't mean that the fiscal conservatives weren't able to force a couple of wins. The fiscal conservatives forced a win from the Senate Democrats and John Boehner, the Speaker of the House. The win they got from the Senate was that the 113th Congress Senate would actually put forward and pass a budget proposal. Now that doesn't sound like rocket science, but as you know, they hadn't done that in 4 years. So now they've done that, and Patty Murray has led that effort, and they've actually put forward and passed a 2014 fiscal year budget. The win they got from the Republicans was that, from Speaker Boehner, was that the Republicans' budget proposal would actually balance the federal government within 10 years. So if we're going to, and it sets up this dynamic where the Republicans are demanding huge spending cuts for any type of an agreement. And the Democrats are saying, well, we'll talk about an agreement, but we want a balanced approach. And when we hear the Democrats say we want a balanced approach, what does that mean? Tax revenues go up, right? And the Republicans are saying, hold on a second, we just did that fiscal cliff agreement. That was a tax deal. We've already paid the tax man. And the Democrats are saying, no, 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 Republicans, we begged you to include this in a grand bargain back in December. We begged you to include the debt ceiling in a deal in December. You didn't want to do that. You wanted to play small ball. Well, we played that ball game. That ball game's over. Now we're on to a new ball game. And this new ball game is about revenue increases. So you can see the two positions of the two parties are still very well entrenched, where the Republicans are saying absolutely no tax revenue increases, and the Democrats are saying absolutely no entitlement changes. And it sets up this dynamic that we're moving into. And if I were to try to distill everything that's happening in Washington down to its simplest form, I came up with this statement. The statement is the debt a real concern or not? That's pretty simple. But believe it or not, 20% of the Democrats absolutely believe that the debt and deficit is a smoke and mirrors issue. It is completely made up. While at the same time, at least 20% of the Republicans believe it's the only issue and be darned anything else. So that leaves 60% of our elected officials that agree that it is an issue, and they just don't agree on how quickly and how it needs to be addressed. So if we're going to talk about the budget, let's understand how the budget works. But I don't know about you, when I hear $16 trillion and $4 trillion, that's a lot of zeros. So I like to think of the federal budget not unlike how I think about a family budget. And what I mean by that is, let's say that in 2013, the United States government brings in $270,000 from all federal tax receipts. The problem is we're spending $355,000, leaving us $85,000 short. Now, if that was just a one-time, one-year aberration, that may not be insurmountable. But as you know, we've had a history of overspending, haven't we? So much so that we built up a credit card balance, if you will, of $1.67 million. Now, just for kicks, I went on a federal government website and I said, if I earn $270,000 and I have really good credit, how big of a mortgage could I qualify for? Guess what it came back and said? Right at $1.6 million. So just maybe this $1.6 million isn't that big of a deal. Oh, I forgot to, I do this every time. I forgot to put in there that I'm spending $355,000. So when I tell the computer that I'm losing $85,000 a year, how big of a mortgage can I qualify for? Zero. Would you loan me money? No. But we're supposed to believe that the federal government can just continue to borrow without any type of long-term ramifications. And I know what you're thinking. You're saying, hold on a second, Jeff. You just told us that we're actually implementing $1.2 trillion of real cuts. So surely that will change this math, won't it? Well, a little bit. We're cutting $8,500 out of our budget in spending. What about that fiscal cliff agreement? You said that was all tax and in dollar terms, the largest tax increase in U.S. history. Surely that will help change the math. Well, we're going to bring in $6,200 of additional revenue thanks to the budget, or thanks to the fiscal cliff agreement. So you can see that we've not addressed the big issue in the middle of the room, have we? It's the annual budget deficit that it continues to dig this hole for us. And you can see what the annual budget deficit has been over the last several years. Now, the good news is in 2013, we're actually going to come in under $1 trillion. which looks like a relative win. We're going to come in about $850 billion behind, under, or over budget. And I'm going to let you in on a little secret. I don't care what President Obama does. I don't care what the Republicans do. Barring any large unforeseen event over the next several years, we're going to be talking about budget deficits being halved. We're going to be talking about $400 billion annual budget deficits. Now that's going to look relatively pretty good, isn't it? Right? And what's in 2014 into early 2015? Election season, right? So it's going to look as though we're going the right direction. But ladies and gentlemen, we don't have a short-term debt problem. We have a medium and long-term debt problem. So let's talk about how the U.S. government is spending its dollars to try to decipher where these issues are. The federal government only spends its money in two ways: mandatory spending and discretionary spending. Mandatory spending here is in green, and discretionary spending is in red. In the mandatory side, we have two areas. One is the entitlement programs, and that's just Medicare, Medicaid, and Social Security. And we also have the interest on the debt. Now, in the United States, you've probably heard of this little thing called the baby boom generation, right? Most of us are included in that generation. And that generation is moving into retirement. As a matter of fact, 10,000 Americans are turning 65 every single day. Every single day. And they're moving into this entitlement portion of the budget. So it stands to reason that that portion of the budget is likely to grow over the next 10 years. Would you agree? Yeah. According to the federal government, just that portion of the budget is going to double in the next 10 years because of the baby boom generation. Now that's a 7.2% growth rate. That's only a problem if the economy is not growing equally as fast. So I want to see a show of hands. How many of you believe that the U.S. economy can grow at 7.2% for the next 10 years? I try not to make you work hard, right? Because I don't see a hand in the room. And that's right. It's not going to grow that fast, so it is a problem. So let's talk about the other little green area called the interest on the debt. Now keep in mind, this is just the interest, no principal payment. The White House was asked, well, what's going to happen to that portion of the budget over the next 10 years? The statement, the official statement they came out with was just that little debt portion of the pie in the next 10 years is going to quadruple. 14.4% growth rate. And that's because of two factors. One, we keep digging the hole because of that annual budget deficit. And second of all, more importantly, is a normalization of the interest rates. As you know, right now we're paying ridiculously low for our money. Well, that's going to change at some point. So you can see that that's going to put a tremendous amount of pressure on the red portion of the budget, isn't it? The discretionary portion. As a matter of fact, that red portion of the budget, just so you know, as a percent of our economy, in other words, a percent of GDP, is already at a 50-year low. A 50-year low in spending on defense and domestic spending. The $2.1 trillion in cuts from the last debt ceiling deal, August of 2011, that $2.1 trillion is being split equally between those two red portions of the budget. So you can see that that portion of the budget's pretty much already contributed at the trough of the federal government, I think you would agree. And it's coming due to the expansion of these two green areas. You see, we are becoming very quickly in the United States a pension fund with an army. And I don't know that that's, sadly, I don't know that that's exactly the direction we want to go. But that's what the math is telling us where we're headed. So if that's the case, then we need to talk about how the two parties want to move forward. And the budget process that we're entering into right now tells us exactly where the two parties want to start these negotiations. What's important to understand about all of these budget proposals, be it the Republicans, the Democrats, or the presidents that came out today, is that none of them will ever end up being law. It's a starting point of negotiations, but it gives us insights into who's driving those negotiations for the two parties. That's why it's important to review. So let's start with talking about Paul Ryan's, the Republican budget coming out of the House. He promised, and they promised the fiscal conservatives, that it would balance the budget in 10 years without new tax revenues. So let's talk about how he does it. Well, first of all, the first thing he would do was actually repeal health care reform. So he would take Obamacare and get rid of that as a reform in our country. Now, interestingly, though, that 3.8% tax that I talked about earlier, generating $700 billion of new taxes, he needs to keep that. So that doesn't go away. How else do we pay for health care reform? Medicare cuts, right? And over the next 10 years, there's $700 billion of Medicare cuts to your doctors and hospitals. Not to you as beneficiaries, but to your providers. He keeps those cuts too. You see, he needs that additional cash flow to make this thing balance in 10 years. So while we get rid of all the good things about healthcare reform, we're keeping the fiscal side of healthcare reform to help pay to balance the budget. So in addition to that, he would change Medicare into a voucher system. That has a bad connotation, which I think is inappropriate. It really just means we're going to have a choice starting in 2024. You can go with traditional Medicare, as you know right now, or you can go to a private option, which the federal government will help subsidize that premium for you. Bottom line, the way it's being proposed now, it's your choice. You can stay and can have traditional Medicare once we would move to this choice or voucher system. He would block grant Medicaid. Right now, at the beginning of the fiscal year, the federal government has no idea specifically how much they're going to spend on Medicaid on an annual basis. They have a rough estimate, but it depends on the claims. Well, what they would do is actually turn it from a variable cost, in other words, we don't know, to a fixed cost. In other words, at the beginning of the fiscal year, they would write a check to the great state of Ohio and then wash their hands of the Medicaid process. If for some reason Medicaid claims in Ohio were dramatically higher than expected, well, the state of Ohio will have to figure out how to deal with that. That's what block granting actually means. Now, unfortunately, that's still not enough cash flow to make the budget balance. So he would also propose, I got cut off here, I apologize. What he would also have to do is cut an additional $4.6 trillion out of this spending. So let me put that in perspective for you. We just talked about these sequestration spending cuts of $1.2 trillion. And President Obama was way too far out in front of how impactful those cuts would be, and I agree, is a bad political move, because we haven't started feeling those cuts, and we will feel those cuts as they start dribbling in. But Paul Ryan, in order to balance the budget in the next 10 years, has to fourfold those cuts on top of those $1.2 trillion cuts. That's the only way he can get that budget to balance over the next 10 years. So there's some real challenges. And that's not to say that there aren't challenges for the Democrats. There absolutely are. In the Senate, Patty Murray came out with this budget proposal. It is a balanced approach, meaning new tax revenues. She would ask for an additional approximately $1 trillion of new taxes. Let me put that in perspective, just like I put Paul Ryan's number in perspective for you. That $1 trillion in new tax revenues, I mentioned earlier, the fiscal cliff agreement is the highest tax increase in dollar terms in U.S. history. That only generates $620 billion over the next 10 years. The Democrats would more than double that with a new $975 trillion of taxes on top of the 620, focused again on the top 2% of our population. So you can see that that number is a little challenged as well. Now, she does include some very generic talk about additional spending cuts, around $975 billion. That includes some things that you could argue whether they should count or not, like the money that we aren't going to spend because we're not going to be in Afghanistan. That's counted in those numbers. But in addition to that, she does all of this without balancing the budget and making no changes to the entitlement programs. Now, you remember the pie chart I showed you earlier. Is it reasonable to assume that we can get ahead of our fiscal challenges in the United States without dealing with entitlements? I don't know. It doesn't seem like math works to me. But in addition to that, she would actually have some additional infrastructure spending. She would spend about $100 billion on additional federal government stimulus to try to get the economy moving again, or moving in a more higher gear, if you will. So President Obama came out with his tax proposal today as well. And when the president gets his budget proposal, it really is much more of a wish list rather than an actual budget proposal. He just sets out where he sees an opportunity to come together. And what you quickly see is that he focused on two specific areas: entitlement changes, which are really ticking off the Senate Democrats, and tax changes, which of course are ticking off the Republicans. So let's talk about that real quickly. He would first of all talk about Social Security changes. The first change that President Obama is talking about is means testing Social Security benefits. And what that means is the higher your income, the higher your net worth, perhaps you get a little bit of a negative factor on your Social Security benefit. Now, what's important to understand is this is only for people who are currently under age 55. Okay? So if you're over age 55, you really don't need to worry about that means testing benefit the way it's being proposed right now. Now, that's not true of this second bullet point called chain CPI. As you know, your Social Security payments grow each year with the cost of living increases, right? Well, that's called CPI. Now, a different way of calculating that CPI is called chain CPI. The only difference is that chain CPI takes consumer buying behavior into account. In other words, if the price of one commodity is growing very quickly, as consumers, we're going to find a lower price option. The best example I've heard, if the price of beef is going through the roof, guess what we're having for dinner? We're going to have more chicken, right? To avoid the price of that beef. And that chain CPI is that difference in calculation. The net effect of that is that it would slow the growth of our Social Security payments over time. Slowly, incrementally, but definitely slowing it over time. Medicare is not that different than Social Security means testing in the sense that higher income, higher net worth individuals would be expected to shoulder a larger portion of their health care benefits. That would come in the form of either premium sharing or additional co-pays and cost sharing within the Medicare programs themselves. Again, they're a little bit undescript. It just came out today, and again, it's more of his wish list, if you will. Now, the tax changes that he's proposing are a little more interesting. Right now, his proposal is that we cap itemized deductions at 28%. So if you're in an income level where you actually pay a higher marginal tax rate than 28%, that means that this cap would actually cause you to pay higher taxes. Now, what are itemized deductions? Itemized deductions are a credit for the taxes we pay to the state of Ohio. They're taxes that or tax breaks that we get for making a charitable deduction or a charitable contribution or a mortgage interest rate deduction. What about the health insurance that we receive from our employer? We don't pay taxes on the premium that our employers pay. Well, that's also in that itemized deduction cap. So you can see that it would be a fairly unpopular thing to do for people who are above that 28% tax bracket, but it would generate quite a bit of revenue. Now, in addition to that, he also talks about loophole closures. And what are loopholes? Well, loopholes are just aspects of the tax code that generally tend to be very focused benefits for different constituencies. For example, as an S-Corp owner, I own my own business, I'm an employee and the owner of my company. Because I am the owner and employee, I can manipulate my W-2 income. For example, a lot of people who are in my situation, they'll pay themselves a very small W-2 income, let's say $20,000. But at the end of the year, I may pay myself a $200,000. By the way, I don't do this in case there's anyone here from the outside. I can pay myself a big partner distribution of $200,000 at the end of the year. Now, I pay income taxes on all $220,000. So why would I manipulate my W-2 income like that? Payroll taxes. As an employee and an employer, I only pay payroll taxes on that $20,000. So that ability of me, the employee owner, to manipulate my income is considered a tax loophole that would be closed. In addition to that, you've heard about these famous oil and gas loopholes. Of course, if you're in the oil and gas industry, you say they're absolutely not loopholes. They're an integral part of your business planning and your business modeling. But also carried interest. Those are those famous hedge fund managers that you hear so much about that are providing labor but being taxed as long-term capital gains. Those are just some examples of some of these loopholes that we've heard about, and those would be closed. Probably the most interesting part of President Obama's proposal is this last line. And we don't have a lot of clarity, unfortunately, on this last line, but what he's suggesting is that your qualified plans, meaning IRA and 401ks, would have a cap of $3 million. A cap of $3 million. But he also has this weird language called, quote unquote, tax-preferred retirement accounts. So all of those accounts aggregated would cap out at $3 million. We don't exactly know what that means because there's no way he can regulate growth. If you were smarter than I and put $1 million in Apple stock a long time ago, you're way past $3 million. But you only put $1 million in. So maybe it's $3 million contribution cap, not a value cap. The tax-preferred retirement accounts, we don't have a definition of what he means by those accounts yet. So we're still trying to figure that out. I was on the phone this weekend with the head of the retirement lobby and the head of the variable annuity lobby. And the variable annuity lobby, gentlemen, does not believe that they would be incorporated into this cap at this point. Of course, a lot of things can change. But that's important to understand is that any type of cap like that, that's a strong statement by the federal government. And certainly somewhat counterproductive in my opinion. So with that, all of these issues that we've talked about, that's what we'll be talking about over the next several months, these different budget proposals going into committee and being aggregated and consolidated down to one single budget proposal that would then be approved by the end of September, going into effect starting October 1, fiscal year 2014. So all of this has to happen in the context of a fairly aggressive second-term agenda that President Obama has laid out. We know that he's moving very quickly towards immigration reform as well as gun control. Later in his second term, he wants to deal with energy policy and have a thought-out energy policy for our country, moving us towards energy independence. But he also wants to tackle comprehensive tax reform. Comprehensive tax reform is truly a 1986 type of overhaul of the individual tax code and the corporate tax code. And both parties want to endeavor or move into that process, probably realistically starting, say, September, maybe even October this year. You're going to start hearing about comprehensive tax reform. His number one priority right now, though, is to win back the House of Representatives. President Obama believes that if he's going to establish a legacy for his presidency, it will come by having a Democratic House, a Democratic Senate, and then he'll be able to lay out what that legacy will be for his presidency. So with that, let me take a break. I realize that I may have lost you or left you with a sense of hopelessness and despair and so forth. But don't worry, your federal government's here to help with that too. If you'll just take a quick note and write down that easy to remember website that the government provides us here, you can go on there and provide the federal government with your personal credit card. And you can transfer as much of the federal debt you want to your personal credit card. And on behalf of all taxpayers everywhere, we certainly would thank you for your support. So, well, with that, let me kind of wrap up real quickly, because I do think there are some great opportunities. And this is what Randy was talking about earlier, and where's the value of your relationship with Randy and his team? Well, we believe that market volatility is going to continue to increase as we get closer to these deadlines around the debt ceiling later this summer. And that presents threat, but it also presents opportunity. And it's that opportunity that your partners, with Randy and so forth, and can help you take advantage of that at Carver. But in addition to that, keep your eye on municipal bonds. If, for example, that 28% tax itemized deduction cap starts to make traction and municipal bonds aren't pulled back, that will have a pricing impact. But what I'm more concerned about, or as equally concerned about municipal bonds right now, is that I think we would all agree there's probably a little more risk in municipal space than we had originally assumed. And so what I'm suggesting is your work with Carver and organizations such as Eaton Vance, the folks that sponsor me here today, they can sit down with you and they can analyze your muni bond holdings and quantify exactly what risk you're taking and make sure you're being adequately compensated for that risk. It's fine to take risk in that space. Just know what risk you're taking. And that's where, again, your partnership with Carver Financial can help you. One thing that we used to talk a lot about back in the 90s, if you remember when we talked about your portfolios, we talked about tax drag. Tax drag is the real effect of taxes on your overall annual rate of return given a certain asset or a certain asset type. So that tax drag discussion needs to be a part of your relationship with your financial advisor. For example, if we think that small cap stocks are going to do really, really well, well, maybe we want to own our small cap funds inside a tax-free environment or tax-deferred environment like an IRA or your Roth IRA or something like that. So being a little more tactical in how we asset allocate and where we asset allocate. Great opportunities for moving forward and again showcasing the value of the relationship you have with Carver. So with that, I just call your attention to our website, thewashingtonupdate.com. I don't know where you'll go if you go to washingtonupdate.com, so go to thewashingtonupdate.com. And we're also on Twitter in case any of you happen to be Twitter active individuals. And with that, I just want to thank Eaton Vance. I want to thank Carver for having me here today. I appreciate your time and your patience as we kind of went through all these different topics. Thank you very much.